passive income using the right investment vehicle. I don't know what vehicle, whether it's PJ or whether it's private jet, whether it's Rolls Royce, whether it's Danfo or Okada. Dr. Banjoko, you'll be teaching us tonight how we can make passive income while we sleep. So, Dr. Banjoko, I'll be inviting you to take over the floor. It's my honor and pleasure to welcome you, Dr. Banjoko, to do this presentation to WBA Worldwide, both Nigeria and the UK. Thank you so much. We will just sit back, relax, and enjoy your presentation.
Thank you.
We have about 150 people. Well, we have about 49, 50 people at the moment. While we wait for the rest 100 members who registered.
Thank you very much, Joy. Like they say, the early bird catches the worm. So we'll
That's
start.
Right.
We'll kick off because we have a lot to go through, and we don't want to keep everyone from their Sunday evening. But thank you very much, Joy. Thank you for the introduction. And,
thank you.
Hello, everyone, and welcome to this session where we'll be discussing the importance of earning a passive income and how to do so. I hope you're all in good health and you're all well. And I'll just ask everyone to stay muted during the presentation. We just kindly ask you to stay muted, and I'll take all the questions at the end of the session. The moderator will go through the chat box and the questions. So if you have any questions as I'm going through the presentation, you can send the questions to the chat box, and we'll come to the questions at the end of the presentation. And kindly stay muted. So like I said, we have a lot to go through, and the presentation will be made available for you all afterwards. So again, you don't have to rush and try and write things down. So I'll just encourage you all to sit back, listen, and hopefully enjoy the presentation. And like I said, the handout will be made available for you afterwards. Okay, so we'll kick off. This is just a quick disclaimer, just to tell you quickly that I am not a financial advisor, I'm not a broker, I'm not a lawyer, I'm not an accountant. Basically, I'm just a private investor and trader in the financial markets. I've been investing and trading in the financial markets for over 20 years, and also teaching and doing seminars for about 18 years now. And I used to be a guest lecturer at the Cass Business School in London, teaching alternative investment management. And I've also been involved in the business world virtually all my life since I graduated from medical school. My background is medicine. I used to be a medical doctor. I used to practice obstetrics and gynecology in the UK. And I quit medicine about 8 years ago. I quit medicine about 8 years ago to move back to Nigeria and Africa, and I'm now based in Rwanda. So basically what I'll be sharing with you all is my experience doing business in multiple streams of income and also in the financial markets for over 20 years. So that's what I'll be sharing with you. So I'm not, it's just to emphasize, I'm not a broker, a financial advisor and all that stuff. Okay, so that's just a quick disclaimer. Now, this is just a quote to get us started, just to help us open up our minds and begin to expand and think laterally when it comes to money and making money. Like this quote says, minds are like parachutes. They only function when they're open. So I think in order to start creating a passive income, doing multiple streams of income, you need to have an open mind. Also be willing to get out of your comfort zone and start to think about doing things differently. Now, financial literacy is what we'll really be talking about. Everything boils down to financial literacy. So what's financial literacy? Financial literacy is basically the knowledge and capability in personal money management. What knowledge and capability do you have when it comes to your own personal money management. So financial literacy is basically the ability to make informed judgments and take effective decisions regarding the use and management of money. That is the key. So the bottom line is what is informing your judgments when it comes to money. So it doesn't matter whether it be, are you opening a business? What's informing your decision to open that business? Whether it be a restaurant, a fashion house, events planning. What is informing your judgments? Are you opening a savings account? Are you investing in a business? Are you investing in the stock market? What is informing your judgments? And that's the key word, what informs your judgment? Because most people get into business, whether it's be real estate, starting their own business, opening a new business, but they're ill-informed before they jump into it. So financial literacy is your ability to make informed judgments and take effective decisions regarding the use and management of money. According to a Forbes article from 2015, it shows that 43% of Americans and a whopping 2/3 of the world's population are financially illiterate. So financial literacy, or financial illiteracy, I must say, is a global problem. It's not a black or white problem. It's not an African or Western problem. It's actually a global problem, financial illiteracy. So this is hopefully, this is what we're trying to sort of cure amongst people. Now, when it comes to the financial markets, the first thing you need to understand is that there's a huge difference between the term trading and the term investing. Huge difference. And I must quickly clarify that difference because it's very important. So trading, when you use the word trading, is significantly different from the word investing. Trading is short term. So as a trader, you're looking to make gains in the financial markets within a couple of minutes, couple of hours, couple of days, couple of weeks. So as a trader, you're looking for extremely short-term gains in the market. Whereas an investor is looking for long-term gains in the market. So when you're investing, you're looking to gain in the market over the next 5 to 10 years. And that's very important because I always say to people that everyone, which I passionately believe about, everyone from the time they're born till the time they die should be an investor. I'll repeat that. Everybody from the time you're born till the time you die, you should be investing long term. That is the way to create wealth and create generational wealth, as I'll show you shortly. But not everybody can be a trader. You have to have a certain mindset, a certain personality for you to be able to trade. So trading is a completely different mindset, a completely different animal to investing. So I don't think everyone should be trading, and not everyone can trade, but everyone should be investing. And that's what I'll be spending most of our time today talking about, which is investing. There's a good quote from Warren Buffett. Warren Buffett, as you all know, is the most successful investor in the world. So Warren Buffett is not a trader, he's an investor. He invests in the stock market or in the markets long term. So he is an investor, and he is the richest investor in the world. He's not the richest man, but he's the richest investor in the world. And I love this quote that he gives. It says, "Risk comes from not knowing what you are doing." And that's crucial because, like I said earlier, with financial literacy, what's informing your judgments regarding starting your business, whether you're starting a restaurant, buying real estate, investing in the stock market, whatever you're doing, what is informing your judgments? And if you're not well informed, then you're going to lose money. So risk comes from not knowing what you are doing. Like I said earlier, I used to be a gynecologist. So for me to do cesarean sections, hysterectomies, that's not a problem. I'm trained to do that, so it's not a risk. But if you're not trained to do that, to cut someone open, that's a huge risk. You might kill the person. Likewise, I've never flown a plane in my life. I've never taken flying lessons. So if I have to fly a commercial jet, that's a huge risk. But a trained pilot is not risky. So you find that most people that tend to lose a lot of money, either in their business or investing, is because they don't know what they are doing. So risk comes from not knowing what you are doing, and you need to be well informed. So the first thing we're going to talk about in terms of financial literacy is understanding consumer price index. This is really the basis of why it's actually important for you to create a passive income. Because once you understand consumer price index, which is one of the indicators to show that you're financially literate, there are a few indicators to qualify as being financially literate. One of them is understanding consumer price index. So I'm going to take a couple of minutes to explain this because this is very important. This forms the foundation of everything you need to know when it comes to setting up a business, investing, or why it's important to create passive income. So what is consumer price index? The other term for consumer price index is inflation. So inflation, consumer price index is the same term. You know, inflation or consumer price index is the same thing. So consumer price index is defined as the rate of increase of basic goods and services over a certain period of time. I'll repeat that. Consumer price index or inflation is defined as the rate of increase of basic goods and services over a period of time. And the key words in that definition is one, the rate, which means it's always moving, and unfortunately it tends to be moving up. And the other key word in that definition is basic goods and services, not luxurious goods and services. We're not talking about designer, luxury lifestyle. We're talking of basic goods and services. So consumer price index is the rate of increase of prices of basic goods and services over a period of time. So what every country does, whether it's Nigeria, Ghana, UK, USA, Canada, every country measures how, you know, the inflation is rising, the cost of living is going up. They do that all the time. But let's break it down even further. So what they do every month, they would take a basket of basic goods and services that everybody in that country uses and see how much has gone up in value, usually over a year. So for example, we're now in the month of September. So what they will do in every country is that they will compare the prices of basic goods and services that everybody uses. They will see how much the prices have gone up from September last year till September this year, and then the report will come out in October, and they'll tell you how much prices have risen by. And in October, they do the same thing. They'll check out how much the prices have gone up from October last year till October this year. It comes out in November. So this report comes out every month, but it's measured over a year, and every month they keep telling everybody that you're in trouble, you're in trouble, you're in trouble, but nobody understands. Because when the report comes out, it's made public, but people don't put significance to the report. So let's go back to the basic goods and services they're measuring. So for example, what they're measuring is, let's take you as an individual in your home. You wake up in a home, you're either paying rent on the home or you're paying a mortgage on the home. So basically, they're going to look at average rent or average mortgage on a house in an average area, not in a flashy area, not in an expensive area. They're going to look at average rent in an average area or average mortgage in an average area. Then you probably wake up from your bed, they look at the average cost of furnitures and fittings. Again, not luxurious furnitures and fittings, basic, you know. Then you go and have a shower, they look at basic cost of soap, sponge, toothbrush, toothpaste. You get dressed, they look at the average cost of clothes, but again, basic clothes, not designer clothes. You know, the average clothes that the average person will wear, not designer clothes. Then you have your breakfast. They look at the average cost of milk, bread, eggs, gari, pap, things like that, baked beans, cereal. You go. Then you then, you know, go out for the day. Either you go to work, or you go to your business, or you go to school. You either take public transport, so they look at the average cost of transport, or they look at the average cost of an average car, average cost of petrol. So you can see these are the sort of things they are measuring in terms of the basic goods and services. Of course, you know, they look at things like your phone bill, electricity bill, gas bill, you know, all these things that you all use on a regular basis. That's what they measure. So that's why the key there, you can see this is what affects you personally, and it's basic goods and services. So let's take it again a step further. So if they're saying that the cost of all these basic goods and services that we are all using, again, not flashy, the basic goods and services, if the cost has gone up, let's say, for example, the cost has gone up by 2% from last year till this year, the cost of all these prices on an average have gone up by 2%, then logic tells you that for you just to have your head above water and just for you to basically survive, then your salary has to go up by the same rate. So if all the prices have gone up by 1%, or let's just say 2%, so if all these prices have gone up by 2% over the last year, then your salary has to go up by 2% too, just for you to keep your head above water. Now, if the cost of living has gone up by 2% and your salary has not gone up at the same rate, then you're going backwards. That's why people run out of money before the end of the month, because their salary is not keeping pace with inflation. So if inflation is going up at a certain rate and your salary is not going up at the same rate, then you're in trouble. And if that happens year after year after year after year after year till you retire, then you're going to retire with lack or in debt. So you can see why the consumer price index or inflation rate is extremely crucial to you as an individual. So you now have to ask yourself that question: is my salary going up at the same rate as inflation? And don't forget that inflation is basic goods and services. So of course, if you want to live a life better than just a basic lifestyle, which most people want to live way above a basic lifestyle, that means your salary has to be increased every year at least 5% more than inflation. Now, if this is not happening to you, then there's a problem. So if your salary is not going up at the same rate or better than inflation, then there's a problem. And then you have two choices. Choice number one is to do nothing about it, knowing that you're going to be in trouble for the rest of your life. Or number two is to do something about it. Hence why the importance to start to create passive income. Because if your salary is not going up at the same rate as inflation, and you can't get your salary to be increased at a higher rate than inflation, then you have to start thinking about passive streams of income to help to bridge that gap. So this is why understanding consumer price index is very important. The other reason why consumer price index is very important is that even if you're running a business, if the rate of inflation is 2% and your own profit at the end of the year is less than 2%, you're not making money from that business. If you have your money in a savings account and the rate of inflation is 2% and you're not getting your savings interest is less than that, you're not making money. If you're investing in the stock market or whatever investment you put your money in and your rate of return is less than inflation, then again, you're not making any money. So you can see the rate of inflation gives you a base to judge, am I making any money from my money being in a savings account? What is my salary doing? What are my investments doing? What are my businesses doing? Are they giving me returns better than inflation? So you can see how inflation covers everything you're doing, whether it's business, investment, savings, and your day-to-day life. So let's have a look at these are some of the latest reports of, or latest figures of some consumer price index. So you can see the latest figure in the UK is 1%. So the rate of inflation has gone up by 1%. In Nigeria, as we know, is 12.82%. And the USA is 1%. In Germany is minus 0.1%, Eurozone 1.2, Canada 0.1, Japan 0.3. So like I say, every country measures this every month. But I just highlighted UK there as 1%. So if you're based in the UK, are your savings, investment, salary, are they going up way better than 1% a year? If you're in Nigeria, is your savings, investments, and whatever you're doing, is it going up at a rate of more than 12% a year? And if it's not, you need to do something about it. So this is just a cartoon showing the importance of consumer price index. This is a chap who went shopping, and before he got to the counter to pay, the prices had gone up. So that's him just say, what do you mean the prices have gone up since I got in line? Just shows you the effect. Now, this is just to highlight again the importance of financial literacy and understanding inflation, because you can see that, I'm just using this as an example, that even the Church of England, which you would think that they would just be concentrating on the Bible and on the church, they actually understand consumer price index, they understand financial literacy, and you can see the Church of England, they have a £8.3 billion investment fund. That's the Church of England. You'll be shocked that, even they invest in the market. They're huge investors in the market. They have an investment fund of 8.3 billion, but this is the key. Their investment objective is to generate a return of inflation plus 5% a year. So, because they know that they need to do better than inflation. So their objective is to have a return of inflation plus 5% a year. And they've been able to achieve this or better every year for the last 30 years. So again, that just shows you the importance of understanding inflation and how you can use it to make good judgments. The other thing you need to understand is interest rates. Interest rates is basically the cost of borrowing money. That's it, as simple as I can tell you. It's just as simple as that. What is the cost of you borrowing money? So for example, if I ask you to borrow me some money and you loan me money, then I'll tell you I'll pay you back at 2% interest rate. So that's just the cost of me borrowing money from you, or the cost of you loaning me money. That's basically what interest rates are. Now, for example, the Bank of England, the interest rate is 0.1%. And you find that the best UK high street savings account will give you 1.6 to 1.4% interest. So basically, when you open a savings account in the UK, most of them will just give you an interest rate of 0.1%. Basically, they are loaning money from you and paying you back at 0.1%. So again, with an inflation of 1% in UK, that's not good for you. In Nigeria, for example, the Central Bank of Nigeria, interest rate is 12.5%. But although the interest rate is 12.5%, the average Nigerian savings account, the interest rate is 1.25%. So again, if you have your money in a Nigerian savings account, the average interest you get is 1.25%. So the banks there are borrowing money from you and paying you back 1.2% interest with an inflation rate of 12.8%. So you can see again, savings accounts are just a waste of time, really. So let's bring you to the financial markets. Again, the beauty, like I said, now that you understand interest rates and you understand consumer price index, the key is that you now want to be able to beat this and get better returns on your money on a regular basis so that you can beat inflation and start to live the kind of life you want to live. And hence the importance of creating passive income and multiple streams of income. And the key word there is multiple streams of income. The financial markets is just one way you can do it. Of course, you have real estate, you have starting your own business, you can go into agriculture, you can set up events management, you can open a restaurant, whatever business it is. But again, you have to be well informed about that business. But the key is creating multiple streams of income and passive income. And the financial markets is just one of them. There's just one way to do that. So what is this financial markets that everybody talks about? Now, the financial market is basically composed of four major components. There are four major components to the financial markets. And the four major components are: one, you have what you call the fixed income securities, which is the bonds and treasury bills. You then have the stock market itself, which is company stocks and shares. You have the currency market or the forex market. And then you have the commodities market, which is oil, gold, coffee, wheat, and all that. So these are the four major components of the financial markets. And this is, again, very important because when most people hear about the financial markets, they just lump it all together. But it's very important to understand that they are all different. You know, there are different components to them, and they have different characteristics. The fixed income securities is completely different from the stock market. Stock market is completely different from the currency or the forex market. The currency market is completely different from the commodities or bond market. Now, the other reason why it's important for you to understand and separate these financial markets is when it comes to investment risk. Now, investment risk is simply defined as your chances of losing money. I'll repeat that. Investment risk is simply defined as your chances of losing money. So if they say something is low risk, it means low chance of losing money. If they say something is medium risk, it means you have some chance of losing money, but not a lot, it's medium. And if they say something is high risk, then it means you have a very high chance of losing money. So, like I said, the first category is what we call low risk. Low risk means low chance of you losing money. And the only financial market that gives you low risk is the fixed income securities market. That is buying bonds and treasury bills. That is the only financial market that gives you low risk, fixed income securities market. That is bonds and treasury bills. And this is where people get into trouble or people get scammed, because anything other than bonds and treasury bills and the fixed income securities market, the risk goes up, period. So that is the only financial market that gives you low risk, which is a low chance of you losing money. And as you can see in the UK, the annual returns you get from UK bonds is 0.013% a year. So you can see that's useless with an inflation rate of 1%. In Nigeria, the savings bond is 4.61%, again with an inflation of 12%, that's useless. So again, you can see the importance of consumer price index. You can then judge these investments as to whether they're any good or not. So the next thing you can then do is go to medium risk. Now, medium risk means there is some chance of you losing money, but if you understand what you're doing, you can manage this risk, but there is some risk. But again, you have to put the risk into perspective, because doing nothing, if you say, okay, I'm scared to take a risk, I don't want to take any risk, and you do nothing, that in itself is a huge risk. Because if you do nothing and you don't take any risks, you're still taking a risk, because inflation is eroding the value of your money, the value of your assets, and you're losing money anyway by doing nothing because of inflation. And of course, in Nigeria, if you take into account the devaluation of the Naira, and even in the US, the dollar is going to be devalued. So you find that doing nothing, if you stand still and do nothing, that's a huge risk in itself, because inflation will erode your money, the devaluation of the currency will erode your money, and you'll still end up with nothing. So either which way, you either have to take proactive risks, whereby you might end up making a lot of money, or you do nothing, which is a huge risk. So again, you have to put this issue of risk into perspective. But medium risk just means, yes, you might have some chance of losing money, but you can manage that if you understand what you're doing. And the best market for medium risk is long-term investment in the stock market. And the key word there is long-term investment. That's why I explained to you the difference between trading and investing, because trading is short-term and investing is long-term. And this is again where people get themselves into trouble with the financial markets, not understanding the difference. So when we're talking of medium risk, we're looking at long-term investment in the stock market. You're looking for 5 to 10 year period. And last year, the S&P, which is the US stock market, returned 29% return last year. And even this year, despite the COVID, which I'll show you later, there's been a good return in the US stock market, even despite the COVID. So long-term, the stock market is a good thing to invest in long-term. But yes, there is some risk, but it's medium. And then finally, you have what we call high risk. And high risk means exactly what it means. It means you have a high chance of losing money. So high risk means high chance of losing money. So that's where trading comes in. So whether you're trading, you can trade the fixed income market, you can trade the stock market, you can trade the commodities, you can trade currency, you can trade any of the financial markets. Sorry, can you all mute your mic?
But she said it to me as I'm not there.
Thanks. So yes, once you go to trading, that's high risk. And you can trade any of the financial markets, but the best financial markets to trade is the currency or the Forex market and the commodities market, where you can get possibly 100% return a year. And I do run online courses for investment and trading. So again, because they're separate. So we have a separate course for online investing, a separate one for trading, because they're completely different. So for you to trade, you have to have a high risk appetite. And that's why I said earlier, not everybody can be a trader. Trading is not for everyone. Not everyone can do it. Not everyone has the appetite for that. But everyone should be investing long term. But again, the importance of understanding this investment risk, once you understand this, this is where you can avoid being scammed and being ripped off. Because unfortunately, what everybody is looking for subconsciously is the Holy Grail. Everyone is looking for something that will give them 100% return with no risk. It does not exist. Unfortunately, it does not exist. That is where people get scammed. That's where people get ripped off. That's where people have their money stolen from them, because it does not exist. If somebody is telling you they're going to give you a return of 100% or even 50%, and there's no risk involved, that is a scam, period. It does not exist. So again, it's you understanding risk. You can't say you want a higher return, but you don't want to take any risk. It just doesn't happen. It doesn't exist. It can't happen. If you want low risk, you get low returns. If you want medium risk, you want to take some risk, you get higher returns. If you want higher risk, you get higher returns. But you have to understand, higher risk means high chance of losing money. Medium risk, some chance of losing money, and low risk means just what it means, low chance of you losing money. And this is very crucial. This alone would avoid you being scammed, because you get a lot of people out there promising you heaven and earth, promising you all sorts of wonderful returns, telling you there's no risk. It's all a scam. You know, as you can see clearly, once you're going above 5–10% a year return, there's some risk involved, period. And anyone telling you anything other than that is just a lie, and they're just trying to scam you. So this is very important. This is just again to highlight what I'm talking about, risk and medium risk. This is part of my investment portfolio in the UK. When the COVID crisis started and the market plunged, of course, because of my knowledge of the market, I started to buy some stocks to take advantage of the market fall. But again, I completely understand risk, and I completely understand there's some risk involved. So this was my portfolio on the 3rd of April. So you can see all the gains here is all negative, 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 all in the red. But again, I wasn't bothered because I know there's some risk involved, and I was prepared to lose money. But you only lose money if you sell. Again, I was buying them for the long term, so I'm not panicking. I understand there's some risk involved. I'm not trading this. I'm investing for the long term. This is just to highlight that. So this was on the 3rd of April. And of course, I am not God. There's no way I could have told what was going to happen after the 3rd of April with the COVID crisis, with what was going to happen. I had no idea, but I understand the stock market eventually recovers and will eventually recover. I don't know how long it will take, but I know the risk and I was prepared to take the risk. But there's no way I could have known what would happen after this 3rd of April. And this is my portfolio as of now. And you can see there's a vast improvement from April to now. Some of them have gone up 52%, 48%, even 87%. But again, I'm not saying you can do this. I'm just using this as an illustration to show you that there is some risk involved. But you know, if you don't panic and you're looking at it in the long term, you can get good returns. Okay, so which do you prefer? Do you want me to give you £1,000 every day for 30 days? Or do you double £1 every day for 30 days? So do you want me to give you £1,000 every day for 30 days? Or teach you to double £1 every day for 30 days? So £1,000 per day for 30 days is £30,000. Whereas £1 doubled every day for 30 days is £2.6 million. So you can see the value of a penny. You know, so you can see it just depends on what are you doing with the money you have. Even a penny is worth a lot if you use it wisely and invest it wisely. So you can see £1,000 per day for 30 days is £30,000, but £1 doubled every day for 30 days is £2.6 million. And what I mean by that is obviously you're not going to get 100% return every day, but that's just day 1 is £2, day 2 is 4, and then 8, 16, 32. So you can do that at home. You can do that at home and you'll see you get £2.6 million. Now, that is the power of compound interest. It's the concept or the principle of compound interest that enables you to multiply a tiny bit of money over time to a lot. And that's the concept of compound interest. So like Albert Einstein says, the greatest mathematical invention known to man is compound interest. So you find prosperous people earn compound interest. So prosperous people are looking for ways to invest their money in vehicles or in businesses or investments that would earn them compound interest and a passive income. Again, this is why it's important to understand all these financial literate terms and use it in your favor, because this is what prosperous people do. With prosperous people, it's not them working hard for their money, it's their money working hard for them by earning them compound interest. So prosperous people, that's what they're constantly looking for, constantly searching, is for where to earn compound interest and where they can put their money to work. So you want to start getting your money to work for you, not you working for the money. Whereas poor people pay compound interest. So it tends to be what we call reverse compound interest, where you're paying compound interest with debt, credit card loans. You know, this is you now paying compound interest instead of you earning compound interest. Again, like Warren Buffett says, my wealth has come from a combination of living in America, some lucky genes, and compound interest. So this is just a chart to quickly show you. This is everyone here starting with $1,000, and this is the blue line is someone with $1,000 but with no interest whatsoever over 10 years. Sorry, over 20 years, it still stays at $1,000. The second person has $1,000 but is earning 10% a year for 20 years, but at simple interest. This is simple interest, is not compounding, which is still better than no interest at all. Simple interest is better, but with simple interest, you can see the 1,000 becomes 3,000 in 20 years with a 10% interest a year. But with the one having 10% a year compounded for 20 years, you can see the 1,000 becomes about 7,000 plus in 20 years. So you can see the exponential growth when you're earning compound interest. Now, this is one more slide just to show you the value of a pound. When you think a pound is just, you know, you say a pound is just a pound. Well, it's just a pound. It doesn't matter. But this is just to show you that, yes, it does matter. You know, because if you save a pound a day, just by you saving a pound a day, you can generate £1 million. So saving £1 a day can help you generate £1 million. That means £30 a month. So you saving £30 every month can generate you £1 million. But it all depends on what annual interest rate you're saving this money at. So this table shows you the annual interest rates. So for example, if you're doing £30 every month, investing £13 every month in an investment vehicle that is giving you 3% compound interest every year, you will get your £1 million in 150 years. Okay, again, and you can see with savings account, you're even going to get way less than that. And it's not compounded because with savings account, it's simple interest, it's not compounded. So you can see again why savings account is just a waste of time. Now, let me jump to 10%. So if you're doing 30%, sorry, if you're doing £30 every month, so you're investing £30 every month in an investment every month that is giving you 10% annual return compounded every year, then you will get your £1 million in 59 years. Okay? Now, the question is, I'm sure, how do you shorten this 59 years? You might say 59 years is too long. Now, I'm sure you all agree the logical answer on how to shorten this duration is just to invest more money. So instead of doing £30 a month, you do £40 a month. That will shorten the duration. Instead of doing 50, you do 100 a month. So by you investing more, you can shorten the duration. The next question is, where do you get the extra money from to invest? Again, you have to cut your expenses. Something has to give. That's why I always tell people sometimes you can make a lot of money from what you earn now. It just depends on what are you doing with the money you're earning now. You have to start thinking, do I need to get a takeaway? Do I need to buy that coffee? Do I need to buy that new pair of suit or shoes? You know, you begin to think very closely and critically about your expenses. Of course, you need to live a life and enjoy yourself, but you need to start thinking very critically about your expenses. Because if you say you don't want to wait for 59 years, then the other way is for you to invest more. And the other way you can invest more is to cut down your expenses. And the other way you can cut down your expenses by you looking critically at every penny coming into your life. What are you doing with that money? How are you managing that money? What are you spending it on? Again, it goes back to what we're discussing about financial literacy and personal money management. Okay, and finally, if you look at this table, if everyone on this call, when you were born, if your parents had opened an investment account in your name when you were all born and started investing every month in our name in that investment account and just been generating interest and then handed that account to all of us at the age of 18, after 18 years of investing, I think most of us would have had a nice, pretty nest capital to start our financial journey on. So again, this is why I'm saying that long-term investing can create generational wealth. And again, although your parents didn't do that for you, they certainly didn't do that for me, but it doesn't stop you doing that for your kids and also educating others. And that's why I love to do seminars from the youth and the young ones so that they can start early. But again, this is what parents have to start thinking about for their own kids, opening investment accounts for them or educating them about investing. And again, this is how you create generational wealth. Okay, so long-term investing, let's quickly talk a bit about that. And because we want to leave enough time for questions. Obviously, I can't cover every single detail about these topics, but this session is just to give everyone an insight into what they should start thinking about and what they should start doing. We just want to open up your minds and start to think about life, money, and all that in a different way. So long-term investing, basically what long-term investing is that it allows you, the investor, to benefit from wealth creation and the growth of a country's economy. So basically, you, the investor, you want to benefit financially from a country creating wealth and growing their economy. So if you think USA is going to create wealth and grow the economy, then you want to invest in that country. If you think UK is going to create wealth and grow the economy, you want to invest in that country. If you think Nigeria is going to create wealth and grow the economy in the long term, again, don't forget this is long term. We're not talking short term. We're not talking the next 3 months or the next 2 years. We're talking 5 to 10 years. Always remember that we're talking long-term investing. So if you think any country is going to create wealth and grow the economy, you as an investor want to benefit from that. And that's basically what long-term investing is all about. You benefiting from the wealth creation and growth of a country's economy. And the way you can do this is to invest in stocks and shares, cash, bonds, and ISA. But you don't need to know everything about this passive financial instruments, just important basics. So basically, if you want to physically benefit with cash in your pocket from the US economy booming or the Nigerian economy booming or the Ghanaian economy booming or the German economy booming, you need to plug into the stock market of that country. So if you want to benefit, you need to gain access to that country's stock market. So for example, if you're based in the United States, if you're not plugged into the stock market there, you're not going to benefit from all the money and the wealth they're creating. If they're creating wealth in the UK and you're not plugged into the stock market, you're not going to benefit. If you're, if Nigeria starts to make money and you're not plugged into the stock market, you're not going to make money. And again, that's the beauty about investing in the stock market, is that you can do that from anywhere in the world. So for example, now, like I said, I'm based in Rwanda, but I'm plugged into the Ghanaian stock market, Nigerian stock market, Rwandan stock market, the UK stock market, the European stock market, the Asian stock market, and the US stock market. So again, that's the beauty of the stock market and the beauty of being able to get plugged into all these countries and begin to earn a passive income while you just do what you want to do. So there are three main ways you can gain access to the stock market of the country you're interested in. So these are the three main ways for you to gain access to that stock market of either the Nigerian, Ghana, UK, US economies to start to benefit if they start to create wealth or grow the economy. So the one main way is to invest directly in stocks and shares, treasury bills, and bonds. So if you buy a UK bond, you're plugged into the UK stock market. If you buy a US bond, you're plugged into the US stock market. If you buy a Nigerian bond, you're plugged into the Nigerian stock market. But again, we showed you earlier the returns of the bonds and treasury bills are not impressive compared to inflation in those countries. Alternatively, you could invest directly in stocks and shares. But of course, if you want to invest directly in stocks and shares, you need to understand how to do fundamental analysis properly, which is outside the scope of today. Like I said, I do run courses for that, but you need to understand how to assess stocks properly. You need to know how to do fundamental analysis. You need to know how to assess countries, industries, how to read financial data, how to make decisions when it comes to stocks and shares. But yes, that's one way you can gain access. So for example, in Nigeria, if you buy GTB shares, you're plugged into Nigeria. If you buy Sainsbury's in UK, you're plugged into the UK stock market. If you buy Amazon shares, you're plugged into the US stock market. But that requires a lot of knowledge. You need to understand how to pick the stocks. But this is one way you can gain access to the stock market of the country you're interested in. The second way you can gain access is to say, okay, I don't know how to pick stocks. So you give it to a fund manager to do that for you. So you give your money to a fund manager. So let's say, for example, we call it the WBA investment fund, and Joy is the fund manager. So Joy is the fund manager for WBA investment. She knows a lot about the UK market and how to pick stocks and shares. So you all give your money to Joy and the WBA fund, and then she actively does the buying and selling on your behalf. But you have to pay her a fee for doing all this work for you, buying and selling. So you pay her a management fee. If she makes money, she shares it amongst everyone that put money in the fund. If she loses money, tough, that's your problem, but you still have to pay her a fee. That is basically what a mutual fund is. And that's why it's called actively managed. And then finally, you have what we call passively managed funds. These are funds that you can invest in that are passively managed. And this is actually the beauty about the financial market, because they have this sort of passive funds that you, as a beginner, can actually start to invest in with very little knowledge. This is where the index funds or the exchange traded funds come in. I will just quickly explain index funds, and maybe when we do the question and answers, we can expand a bit on that. But I'll just quickly explain it, and then we'll move on, and then we can come to that during the question and answers. Basically, every country has a stock market. And if the stock market is doing well, you can infer that the country's economy is doing well. If the stock market is doing badly, you can infer that the country's economy is doing badly. So for you to be able to determine this, you need to be able to measure the performance of that country's stock market. So that actual measurement, which is a mathematical calculation, that actual measurement of a country's stock market performance is called an index. And each country has a different way they measure the performance of their stock market. So for example, in the UK, although there are over 2,000 companies listed on the UK Stock Exchange, they only use the top 100 companies to measure the performance of the whole UK stock market. That's why you hear about the FTSE 100. So that FTSE 100 is the UK index, because the 100 means they're using the top 100 companies to measure the performance of the whole UK stock market. In the US, you have the Dow Jones 30 and the S&P 500. So the S&P 500, again, the 500 means they're using the top 500 companies listed on the American Stock Exchange to measure the performance of the whole American stock market. In Germany, they have the DAX 30. Again, the 30 means they're using the top 30 companies listed on the German stock exchange to measure the performance of the whole German stock market. In Nigeria, we have what we call the all-share index. They use all the companies listed on the Nigerian stock exchange to measure the Nigerian stock market performance. So basically what an index fund does is just basically tracks the index of the stock markets. So basically, if you buy a UK index fund, you're basically investing in a fund that's tracking the performance of the top 100 companies in the UK. If you buy a US index fund, you're basically buying a fund that's tracking the performance of the top 500 companies in the US. So you can see the index fund just makes investing very simple for you. So if you think US is going to do well in the next 5 to 10 years, you just buy a US index fund on a monthly basis. If you think the UK UK economy is going to do well in the next 5 to 10 years, you just buy a US index fund. Again, remember this is long-term investing, not trading. Okay, this just sort of highlight again what mutual funds are. So like say this is the fund house. So you can call that the WBA, the Women's Business Association Fund House. So all the investors pool their money, put it in the WBA fund house. Then Joy is the fund manager who will do the wheeling and dealing. And then she will generate returns, which is passed back to you, the investors. But of course, if she makes losses, again, tough. So that's basically what a mutual fund is. So going back to the basics of long-term investing, basically what you want to do, there are 3 stages. You want to filter, decide what stocks to buy, what bonds to buy, what mutual funds to buy, index funds to buy, or exchange-traded funds to buy. So you have to go through a filtering process. And then once you've filtered and decided what to buy, timing in when do you buy it, and then timing out when do you sell it. So the filtering process, like I said, can be made easy for beginners because, like I said, there are over 2,000 stocks and just as many mutual funds to choose from in the UK alone. But like I said, most mutual fund managers in the UK are trying to beat the return of the FTSE 100. And those in the US are trying to beat the returns of the S&P 500, and over 95% of them are unsuccessful because it's difficult to beat the performance of the top 100 companies in the UK or the top 500 companies in the USA. And like I said, over 95% of fund managers, that's the gold standard. The returns of the individual country's index is the gold standard for that country return. And that's what most fund managers, that's the benchmark for them to try and beat that. All these fancy managers in Wall Street and the London City. But over 95% of them can't and don't beat the return of the FTSE 100 in the UK or the S&P 500 in the USA. And even the less than 5% who beat the return of the index, they don't do it year in, year out. So I always say if you can't beat them, join them. So usually for people who are new to investing and beginners, that's the one I can safely get them to start investing in, which is index funds. If you're based in the UK or in the Western world, you also have to think about tax efficient ways to invest because in the Western world, if you open certain investment accounts, you have tax benefits. Unfortunately, we don't have that in Africa yet. Apart from buying Nigerian bonds, you don't pay taxes on Nigerian bonds, but other than that, everything else you pay taxes on. But in the Western world, you look into the tax efficient ways to invest. So in UK, for example, you have the ISAs, which is the individual savings allowance. You have the self-invested personal pension. These are the ones that gives you tax benefit ways to invest your money. In the UK, in Canada, you have the registered retirement savings plan and the tax-free benefits for tax-free savings account. These are the ones you have in Canada. And then in USA, you have the 401k and the IRA. These are all tax beneficial ways to invest for the long term in these countries. So whichever country you are, you can find out the tax efficient way to invest in the long term. Timing out, again, just remember that the longer you invest, the lower the risk. So you're looking at 10 to 20 years. And remember, long-term investing means exactly what it says, long term. So always take a long-term view on your investment. So these are just some of my investment brokers. By the way, I'm just a client with them. I don't work with them. I don't earn commissions from them. I have no dealings with them. I'm just putting them up because these are the ones I use personally. But like I said, just to quickly let you know, I don't earn commissions. I'm not an affiliate. I don't work for them. I have no affiliations whatsoever. So I'm not saying you should open a brokerage account. So whether you use them or not, that's up to you. But this is just to show you my brokerage accounts. This is the one I use in the UK. This is the one I use in Nigeria. This is the one I use in Ghana, and that's the one I use in Nigeria. And again, like I said, we share the slides with you all afterwards. Now, I'm just going to end by talking about the monetary formula. Like I said, the key is to create multiple streams of income in terms of creating multiple streams of income and passive income. But while you're creating your multiple stream of income, think about this monetary formula, which is the one I use personally, because I'm very lazy. I don't like hard work. I like easy money. I don't want to work too hard for my money. I want to enjoy myself and do what I love doing, which is working with the orphans and widows in Rwanda and enjoy my time with family and traveling. So I don't want businesses where I have to spend all my time doing that business. I don't want to buy myself a job, so to speak. So I use this monetary formula when I'm looking at businesses I want to get involved in. And I'll just quickly go through this. And like I say, you're going to have the slide. Now, this was devised by Robert Allen, who's an American. It just helps in determining whether a business will be viable and help you generate residual income. Because most of the business I like to get involved in, things like real estate, things like agriculture, and some other businesses I'm involved in, they don't require much of my time, which is good. And I use this formula. So the M in the monetary stands for multiple streams of income. So you want to choose businesses that can help you generate multiple streams of income. And again, the financial market is one of them, because like I told you earlier, my investment portfolio cuts across Nigeria, Ghana, Rwanda, Europe, UK, Asia, America, and in different sectors and in different countries. So the financial market gives you that. You can get multiple streams of income from different places. And most of the companies I invest in also pay me dividends on a regular basis. So you get a regular income from all these companies. So the financial markets helps with that. The O in the monetary is outstanding. You want to look for things that's unique, a unique service, a unique product, or unique information. And you don't want to be stuck between price and quality. If you're going to start a business, you want to make sure you're either the cheapest or the best. You don't want to be mediocre in between. If you're the cheapest or you're the best, you always do well. So it has to be outstanding. N is for nothing down. Lots of money leads to poor choices. So you want to try and start businesses where it doesn't require a lot of your money. Also, you can do that with partnership with people. E is employee resistance. So you want to outsource. I don't have any employees. Most of the people I use are either my partners or we just outsource it, like, the accountants, lawyers, brokers, and stuff like that. I haven't got time to be hiring and firing people and be watching over people. Again, this is just me personally. I don't want a job. So E is employee resistant. Y is high yield businesses. You want cash cow businesses. Again, this is where understanding consumer price index and inflation comes in, because you want businesses that are really going to help you beat inflation. You look at trend and timing. The COVID crisis has made everyone focus and begin to think about, the businesses they're doing, excuse me, and what they're doing. You have to be doing things according to the trend and timing. R is residual income. Again, you want to be getting passive income. You want to avoid the monkey trap or the rat race. You don't want to always rely on linear income. Linear income is just a salary. salary is a linear income where you just have to wait for the end of the month to get your salary. And of course, as we all know, there's nothing like job security. Even in medicine, there's nothing like job security. You can be sacked or let go at any time. So once that happens, that's the end of your linear income. And you're reliant on your employer as to whether they cut your pay, whether they increase your pay and all that. So you want residual income and you want to avoid the monkey trap or rat race. You want businesses that are essential to everyone every day. E is enthusiasm, very important. You have to have a passion for what you're doing. You don't just do things because other people are doing it. People tend to just go with what everybody's doing. So for example, you might hear people are making money from events management. But if you're an introvert, you don't like socializing, you don't like talking to people, you don't have a passion for that, then it doesn't make sense you should go into events management. So you need to have a passion for what you're doing. And we'll just end with this quote, which says, "I'm not afraid of storms, for I am learning to sail my ship." So yes, the road to financial freedom and financial security, there's a lot of storms ahead. There are a lot of risks you have to take. There might be a lot of problems you might have along the way. But if you learn, you get enough information, you educate yourself, and you make informed judgments, that you will not be afraid of the storms because you're learning to sail your ship. Okay, so thank you all. That's just one of the books I wrote on trading and investing. Oh yeah, I do have a podcast which you can listen to, obviously for free, on trading and investing. And like I say, yeah, we do have a trading course. Unfortunately, we only have one left this year. We have a course starting on the 15th and 16th of September. Spaces are very limited because we can only take a fixed number of people to make it an effective course. And it's the last one for the year. And then we're not sure when next year we'll schedule the next one. And this is our contact details. So thank you all for listening. And we'll just bring in Joy and we'll take questions. So you can send your questions through the chat box or you can raise your hands. Joy?
Thank you so much, Dr. Banjoko. I've learned so much today. We all have we have a lot of information and we can make our informed decision. Thank you so much. Thanks for your time.
It's a pleasure.
So we'll take all the questions now. If you've got questions, you can send it through the chat box.
Before the questions, can I just say one or two words, please?
Sure, Kumbi, over to you.
All right. Okay, excellent. I hope everybody enjoyed that presentation, and I really, really hope that you learned a lot. What we found is that, and why I was so interested in bringing this seminar to the WBA ladies, and also other ladies that I know, is that because there is such an investment gap between men and women. Only 1 in 5 women ever invest, as opposed to the men. And why do I want women to invest? Because really, at the end of days, nearing the end of your career, you always have to think to yourself, am I in a position where I am financially well? Do I have financial well-being? And really, the research has shown that many women at the end of their career are really worse off than the men. So it's an important thing for us women to begin to think, how can I really make passive income? Many women are very, very hardworking. I know so many enterprising women, they work so hard for their money, but at the same time, why don't we look at instruments? Why don't we look at opportunities where our money can work hard for us? And this is really why I am passionate about it. I myself am a woman that's nearing retirement, and I took one look at my life. I've worked a lot and I've worked a long time. But as I approach the end of my career, maybe another 10 years, I look at my finances and I'm thinking, wow, they say that 50 is the new 30. If I live to 100, How am I going to manage myself? You know, and these days, many people say, in our own days, we looked after our parents. But really, anyone who's relying on children to look after them, especially the children we're having now, that is no plan. That is no plan. The main plan we have for us ladies is to look at this instrument, passive income, and to look at how we can do it. I love Dr. Banjoko's course simply because he makes it so easy to do. I myself have gone through the course, I can tell you, and I can tell you that I'm a changed person by association with this man and being on his course. My mentality has changed. If my parents had taught me what he taught me, believe you me, I wouldn't be in my situation. However, I look now before I spend. And I am so passionate about this, which is why I will always speak to women about how they can invest. It's not rocket science. You can do it. And also, one other myth, people think you need a lot of money. No. When I started investing, it was only £25. That's all you need. If you're in the UK, you need nothing more than £25 a month to invest. Come on. If at the end of your life, at the end of your working life, you're going to have something to show for it, surely we can give up £25 a month. I won't say more than that so that I don't keep people. And if there are any questions, please put the questions in the chat box, and I will really encourage you to go for the investment course. It's the last for the year, and it doesn't know when next year we'll be doing one. So try and sign up for this one. Thank you so much for listening, and thank you so much for coming. Joy, I can't believe there are over 80 women on this course today. I celebrate you. And
we have 81 women.
81. I really applaud you, and well done.
Thank you. Thank you.
The WBA women. I like forward-looking women like you.
Thank you so much, Kumbi.
Excellent. So over to you, participants, with your questions.
Okay,
we have a few questions there.
I'll just go through them. Yeah, I'll just go through them one at a time. Thank you very much for that, Kumbi. Thank you very much. I will just go through the questions one at a time. It says here, is it advisable to keep checking whatever shares you buy long term or avoid it because of anxiety? That's a good one. Yes, you don't. Again, I think this is why there's a lot of things in that question. Number one, you have to ask yourself, why did you buy that share in the first place? Because again, this is why I took pains to talk about the difference between trading and investing. So if you're investing in the long term and you're looking in the long term, then yes, you shouldn't be checking the shares all the time. But again, also, this is what I talked about earlier about, do you know how to assess shares? Because when you're buying shares, you know, I was talking about fundamental analysis, which means you need to do your analysis on 3 levels. You need to have analyzed the country, you need to have analyzed the industry sector you're looking at, you need to have analyzed the company in detail. Now you need to know exactly everything about that company before you invest in it. Because if you do your homework well before you buy the shares, then yes, you don't have to worry and be checking it all the time. I don't check my portfolio every time. I probably check it once every 3 or 4 months because again, it's for the long term. I trade, I'm a trader, I trade and invest. So yes, when I'm trading, I check my trades every day. In fact, I check my trades a couple of times a day, but that's trading. That's a different ball game. But for investing, you shouldn't be checking it all the time. But that's, again, depending on if you did your homework well to start with. There's a question here about platforms for fractionated shares. I personally don't have any experience using platforms I know about them. Basically, this platform for fractionated shares means that you can buy maybe a quarter of a share. So if you can't afford to buy 1 share of Apple, you can probably buy 1/10 of the share. So you can buy a fraction of the share with this fractionated platforms. But personally, I don't have any personal experience with them. I use standard brokerage platforms. Let me use that as an example to bring something up. because I was talking about index funds and the like. So I want to give you a quick example of one of them while I'm talking about fractionated shares. So like I said, this is the brokerage account I use in the UK, Hargreaves Lansdown. Again, I'm going to share the slides with all of you afterwards. So this is a standard brokerage firm I personally use. So obviously I can only advise on what I use personally. And all the brokerage firms I deal with, they don't do fractionated shares. You buy the actual share. So that's the one I do. And this is the brokerage account I use in the UK. But the good thing about this one in the UK, it gives me access to Europe, Asia, and America and Canada. Now, let me just quickly go to funds. And I'm just going to quickly show you an index fund that I was talking about quickly. Like I said, this is something that just makes it very easy for beginners to jump in and do, and just track the whole performance of a whole country. Oops. So yes, I have heard about fractionated shares platforms. I know people who use them. Some people have problems with them, some people don't, but I personally don't have an experience with them. So unfortunately, I can't tell you whether they're good or not. Now, this is a Fidelity Index US. So this is a US index fund. So you find that with index funds, they're labeled index. You can see they're actually quite cheap, because you can see if you buy this fund, the charges is 0.06% a year. But you can see this is the performance I wanted to show you. So you can see if you've been investing in this index fund every month for the last 5 years, this is the returns you would have been getting, and the returns are compounded. So you're getting a compounded return. So you can see this is the performance of this index fund over the last 5 years. So you can see from 2015 to 16, 31% return, 16 to 17, 18% return, 17 to 18, 20%, 18 to 19, 7%. Even with this COVID, from September 19 to September this year, you can see it's a 10% return. So you can see it's well over 10% average a year over the last 5 years. And you can get compound returns with that. So you can see that's why I was saying index funds is really a no-brainer. So I just wanted to highlight that while I was talking about fractionated shares platform. Let me go to the next question. I'll just try and go through. There's somebody's somebody's mic is on.
He said to work.
Sorry, let's see. Okay, I've seen Vivian's hand. I've seen your hand up. I'll just quickly go through some more questions in the question box, and then we'll unmute you, Vivian, to ask your question. Thank you, Lara, for the comment. Are the tax breaks only for those who are in the country, or are these tax breaks for those who invest from outside the country? Doyinbo, the tax breaks are for those based in the country. So yes, so if you're based in UK, for you to benefit from those tax breaks, they'll ask you for your NI number and all your details. Same in the America and USA, so they'll ask for your tax details. So yes, you need to be based in those countries to benefit from them. I know stock valuation, that's from Alaiton. I know stock valuation is a whole lot, yes, but can you please give us a basic guideline for stock selection? I can give you a basic guideline, but I think I said it earlier. The basic guideline is that if you want to buy a stock, you have to start from analyzing the country of where the company is based. And you need to know a lot about that. So for example, if you want to buy Apple shares, you don't just go straight to to buying Apple. If you want to buy Apple shares, you first need to know about the US economy. You need to know about the US landscape, the thriving industries in US. You need to know about the US GDP rates, the trend of the US GDP, the trend of the US inflation, the trend of the US unemployment, the trend of US interest rate. You need to know the thriving industries. And then when you go to the thriving industries, you need to know, so for example, like Apple, you need to know about the tech sectors, which are the thriving companies in the tech sector. Then you then go to Apple itself, and then you need to know about Apple. You need to know what they do, who their competitors are. You need to know about their financial data and all that. So you can see there is a lot you need to understand and know before you pick that stock. So that's the basic guidelines. Lola says here, thank you. Pleasure, Lola. How do I register for the course? Yeah, you could just go to our website. Let me just quickly bring that up. So if you go to our website, all the details are basically on our website at www.nextgenflx.com. So yeah, all the details are on the website. We'll send you, we'll share with you an email at the end. You can contact Kumbi because like she said, the course that's on the website is the last course for the year. So if you go to our website, like I say, this is our website, nextgenflx.com. So if you go there, you can just click on courses, and that will take you to the pages where the courses are for the trading and investing courses. But like I said, there are limited spaces. We can only take a maximum of 30 people per course. And of course, we already have quite a few people who already registered and paid. And once we hit the number 30, the registration will close and you will not be able to make payment online once we fill up the spaces. But we'll share with you at the end. If you find you want to register and you can't, and you're unable to register, then it means it's full. And you can then contact Kumbi and she can tell you what the next plan might be. But yes, you can just go to the website for the details. Let's see. When is the next course and how can I start investing? Still a bit clueless. That's from TT. The next course, like we say, starts on the 15th. Is it 15th? I think it's on the 16th, but it's on the website. Like I said, if you click on courses, this will bring you to this page where it tells you all about the courses. And you can see here we have the online Forex trading course and then the online investing course. Yes, there you go. It starts on the 16th of September. So it's from the 16th to the 17th, twice a week for 5 weeks on Wednesdays and Saturdays. The times are there, and then you can just click there for more details. And that will show you where you can register for the course. It tells you all the sessions, the details of all the sessions, the 10 sessions. So all the details are there. The cost and how to pay, it's all on the website. And actually, if you're a bit clueless, you probably benefit more from it because then you can learn things properly from the foundation up. Because usually I find the people I tend to have problems with are those who've learned how to do this thing badly and they're trying to unlearn bad habits, which is always a problem. But yes, it's a course that it doesn't matter what level of experience you have, you'll still benefit from it. And I personally think even if you're clueless, you'll probably benefit more from it because then you learn things properly and you don't have to unlearn bad habits. But yeah, all the details are on the website. And also if you go to the website under the categories here, if you want to watch videos, I mean, there are testimonials on the that you can look at and also videos of some of the practical sessions we've done to see how people who've been on the course, how they fared by the time they got to the practical session. By the time they got to the final practical session, you can see how they fared. Okay, so let's carry on. Must you be a UK resident to invest in Hargreaves? Yes. If you want to open a brokerage account with Hargreaves Lansdowne, you have to be a UK resident. What do you think about Bitcoin? Bitcoin is good, but Bitcoin falls under high risk. So if you want to invest in Bitcoin, it's high risk. So you have to be prepared to lose money. How does one from Nigeria invest in mutual funds abroad? Unfortunately, if you're based in Nigeria and you want to invest in mutual funds abroad, you will have to open a brokerage account abroad, unfortunately, because unfortunately the brokers in Nigeria don't have access to the financial markets abroad. So unfortunately, yes, if you are based in Nigeria, you have to open a brokerage account abroad. There are some brokerage firms that allow you to do that in Nigeria, like Trading 212. There's Trading 212, there's Bamboo, there's some other sites that can give you access. But again, I've had people have problems with them. I know people who put in dollars to invest, and when they come to withdraw, they had problems withdrawing their money, or they will give them the money back in Naira, although they invested in dollars. So I've heard a lot of horrible stories about people when they try and get their money out. So again, like I said, I can only advise on platforms I use personally. But yes, I've heard about, things like Bamboo, Trading 212, that you can use in Nigeria to access the global markets, but do your own due diligence, because I've had a lot of horror stories. So I wouldn't want to personally recommend them because I don't use them personally. Thank you, Toyi. Any advice on platform from Mary? For example, IG Market. Yeah, IG Market is good. I use IG Market actually for trading. So IG Market I use for my trading. So that's the platform I use to trade. But I don't invest through IG Market. But it's a good platform, IG. I use it. And Trading 212, I just told you about that. Is Bitcoin another way of investing? Yes, it is, but it's high risk. Bitcoin is a way of investing, but it's high risk. Thank you for the link. Okay, let me actually put the link there. I just saw Kumbi put the link there. Well, that's the link to give you details about the online courses. Do you have shorter, more intensive courses? Oh, that's from you, Joy. Shorter, more intensive courses. I used to, but I'm getting lazy with age. So yes, I used to do 3 days. I used to do a 3-day, is it 3 days or 2 days? I can't remember how many days it was now. I think it was a 3-day masterclass I used to do in the UK and Nigeria in person. I used to do an in-person 3-day, I think it was 3 days. I can't remember if it was 3 or 2 days. Where we do the sessions from 9 in the morning till 5 p.m. In fact, there was a time in the UK too, I used to do a weekend retreat where we meet on a Thursday in a retreat in White Boston from Thursday night till Sunday morning and talk all things trading, investing, real estate, wealth protection. But yes, now that I'm settled in Rwanda, as you can see from the scenic view of Kigali, that's just a picture background of Kigali. Now that I'm here in Kigali with my dear widows, they've kidnapped me here, so I don't want to leave anymore. So if you want a more intensive course, you have to come to Rwanda.
Oh my God, that's a long way.
Can we get in touch with Sister Joy regarding mutual funds? I
have no clue. I'm learning.
I think Sister Joy can actually arrange a more intensive course, and once you're able to arrange it, you can do a private arrangement anytime.
Yes, because I think 5 weeks is quite long, because there are loads of Zoom lessons and everything. So if we can arrange privately for the more intensive one, if we can get enough people together.
Yes, once you have about 25.
Yeah, you can discuss.
Once you have about 25.
Yeah, you can discuss with Kumbi. In fact, let me bring that up actually. And then you have to get permission from the widows here.
Yes, please, we will. We will. We will.
Okay, let me quickly go through this so we can end on time. Investing costs and trading costs are separated. What do you suggest I do first? Nick, it's up to you. Obviously, I don't know your risk appetite. I don't know. I mean, some people who've been through the course did both of them at the same time, and some did one at a time. But again, like we said, this September course is the last for this year for both of them. But again, it depends on your personality, whether you can cope with two at the same time, whether you have a high risk personality or not. So I can't give a blanket statement. It really depends on the individual. Some people have done both at the same time. Some people prefer to split it. Let's see. The problems are not with trading 212 regarding Nigeria. The issue is Nigerian banking system and restriction on dollar. Okay, that's from Aussie. So again, like I say, you have to do your own due diligence regarding trading 212. Like I say, I don't have any, I don't use them personally. What about investing in Ethereum? Ethereum too is part of cryptocurrencies. So whether you're doing Ethereum, cryptocurrency, or any of the whether you're doing Bitcoin, Ethereum, or any of the cryptocurrencies, they're all high risk. What's your take on frostage? I don't know what frostage is. I have no idea what frostage is. I know sausages, but I don't know what frostage is. Many thanks. Some understand. I hope to gain more. Okay. The 5 weeks goes quickly, and there's a lot to digest if you are new to it all. Okay, Kemjika. Hello, Kemjika. So yeah, that's a good feedback from Kemjika, who's been on the course. So like she says, the 5 weeks goes through quickly. And I think to Kemjika's point, I would highlight that for Joy, who wants to have an intense course, you need to be careful what you wish for. Because the 10 sessions are over 5 weeks. It's 2 sessions a week over 5 weeks. But like Kemjika has rightly said, there is a lot to go through. And, you know, you might have, if you're going to be doing them 1 hour at a time, you might find it overwhelming. You might find it too much to take in, and you might struggle to keep up. So be careful what you wish for. So thanks for that, Kemjika. Because she's been on the course, so she's telling you from her own experience that the 5 weeks course. But so yeah, I'm happy to do intense, but I would dish out the information, but whether you can take it or whether you find it overwhelming. And of course, the aim, my aim is to make people make sure that they start investing straight away. I don't do the course just for the heck of it or just for you to learn and have an academic knowledge. My aim is for people to start investing. So I personally, I would be disappointed if you just went through the course and just got overwhelmed and confused because it was all too much and too quick. Then I would have achieved my own goal. So again, you have to take that into consideration. But yeah, you can have a chat with Kumbi about that. Any advice on bonds? Yeah, bonds are good and they are low risk, but like I told you during the presentation, their returns are very low compared to inflation. So like Kumbi said, if you had kind of advice on one stuff in investment, I start on the next course and really looking forward to it. Oh, hello, Lara. So we look forward to having you. And oh, thanks for that, Ellie, recommending the course. Okay, any questions? Anyone that wants to raise their hand? I think I've gone through the question box and we'll see if there are any raised hands or any more questions. So if there are no more questions, I would hand back to you, Joy.
Thank you so much, Dr. Banjoko. This has been very informative. We are Oliver Twist. We would like to invite you again. Once we have a huge group back together, we have a huge appetite at WBA. Thank you so much for your time.
No problem.
I have
it's a pleasure.
So much, and I'm looking forward to taking the course myself.
Yes, and we look forward to see you in Rwanda.
Soon, hopefully. Virtually, we will be there in Rwanda, virtually.
All right, then.
Thank you so much, Dr. Banjoko.
Pleasure. It's been a pleasure.
Kumbi, thank you too for putting this together. Are you there, Kumbi?
Thank you so much. It's been a pleasure And I really hope